Is your mortgage coming up for renewal or you are planning to buy a house? Then should you fix your mortgage or keep it as a variable interest rate? It's a very important question because most of your monthly income goes for your monthly mortgage payment. So taking the right decision is very important. 20% of Canadians renew their mortgage every year. On top of that, many people become homeowners. So it's very important to have the right decision when it comes to mortgage interest rate. A fixed mortgage interest rate always based on the bond market performance. But when it comes to variable interest rate, it is always based on the prime rate. So Bank of Canada announced prime rate. So the time to time they announce prime rate in order to navigate the economy. So they might increase the interest rate or prime rate or maybe a decrease. So they always use interest rate as a tool to control the inflation. Even though Bank of Canada announced the prime rate, each and every bank has their own prime rate. Always their prime rate is higher than the Bank of Canada prime rate. It makes sense because they borrow from Bank of Canada and lend money and they have to keep the spread to make profit. So it's always good idea to check with your own bank what is their prime rate. So because each and every bank may have a different prime rate. So variable interest rate always fluctuate based on the prime rate. So usually the variable rate is maybe prime plus certain amount or prime minus certain amount. So that is how if the prime rate is varying, so your monthly mortgage payment also could vary. Historically, fixed rate is higher than the variable rate. You can see this graph. You can see the prime rate which indicate and the blue line is lower than the 5-year fix. So the bank in this bank, their prime rate is lower than their fixed rate. This is 20 history, 1990 to 2010. So you can see in this 20-year period, time to time, blue has surpassed the red line. It happened in 1990 for a short period of time. Again 1990, this period 1992 to 3. So again shorter period of time of 1999. So most of the time the blue was below than the 5-year fixed rate. So this is the historical figures. So now the interest rate is high. There's a possibility that it could lower. Because of that, sometimes people are thinking, I will go for variable interest rate because there's a possibility that it might decrease. But even though you want variable, bank may not give it to you, especially if you are getting a new mortgage. As example, if you are a first home buyer, so you apply for a mortgage and they may say you are not able to get variable interest rate but you can get a fixed rate. Then why is that? Let's see why you may not able to get variable interest rate. Have you heard about a stress test? That is the main culprit. This is how it works. So as I said, currently the variable interest rate is higher than the fixed rate. It doesn't matter variable or fixed rate. So they run stress test. So what does it mean? They add 2% on top of your interest rate, then they run the stress test. So it means they run your stress test at 6.89% instead of 4.89 to see whether you are able to pay that mortgage even the mortgage interest rate increased by 2%. That doesn't mean your mortgage interest rate is 6.89%. You are not paying that, but you are paying only what you're supposed to pay. But you have to qualify for higher interest rate to get the mortgage at this interest rate. Now the challenge here, if you apply for a variable interest rate, since the variable interest rate is higher than the fixed rate, so you have to qualify for higher interest percentage to get variable interest rate. Therefore, most of the people may not able to get variable interest rate, say as example if they are first time home buyers. That's the main reason you may not able to get variable rate interest rate even though you want. But if you are renewing your mortgage, usually banks send you a renewal notice 90 days before. So it explains what is your interest rate in variable. If you go for variable, how much is your interest rate if you go for fixed rate. So what's the solution for that then? So if you're thinking that interest might go down without going for a fixed rate, then what's the solution? So one thing you can consider is, if you are thinking that there's a possibility that the interest rate could go down, you can go for a shorter term fixed rate. But if the 5-year fixed rate is 4.89, so if you go for 1 year or 3 years shorter term, it is always higher than the fixed rate. So that's the downside. So you are paying higher interest rate if you pick shorter interest rate. Either way, bank is winning, but at least you can take educated decision once you understand the numbers. It is very important to decide whether you go with fixed rate or variable rate, because we are in a higher interest rate scenario right now. There's a possibility that interest rate could decrease. We never know. It can happen either way. But historically, variable rate interest rate lower than the fixed rate. Another important thing you should consider is that what is your long-term and short-term goals. So if you are planning to refinance, or you are planning to sell the house before the term end, then you have to take decision wisely, because usually if you take a variable interest rate, so the penalty is about 3 months interest. But if you take a fixed rate mortgage, so you have to pay the penalty for the remainder of the term if you break the mortgage earlier. That's why it's very important to take decisions according to your plan. So everything has to coordinated and integrated to your master plan. That's why before you decide whether you go with a variable or fixed rate, you have to have a better understanding what is your short-term and long-term goals as well. Take a decision wisely. It will save a lot of money and a lot of stress along the way.